We are taught that reserve currencies are stable, that central banks hold dollars because they trust American debt, that foreign exchange reserves protect economies from crisis. But this is the version they teach in economics textbooks to maintain the illusion of financial stability. The truth is that on August 11, 2015, China triggered the largest currency devaluation in 20 years, and the mechanism they used to defend the yuan burned through $1 trillion in reserves and sent global markets into panic. This is the story of the day that proved no reserve is safe. To understand what happened in August 2015, you need to understand the disaster that preceded it. In June 2014, the Shanghai Stock Exchange was trading at 3,000 points, respectable, stable, normal. 12 months later, in June 2015, it hit 5,166 points, a 70% gain in 1 year. This was not organic growth. This was mania. The Chinese government had spent years encouraging citizens to invest in stocks. State media ran headlines celebrating the stock market dream. The People's Daily published articles declaring that 4,000 points was just the beginning. Interest rates were cut 5 times to make borrowing cheap. And critically, in November 2014, restrictions on margin trading were relaxed. Ordinary Chinese citizens could now borrow money to buy stocks. By early 2015, margin debt exceeded $400 billion. Retail investors were borrowing against their homes to day trade. Some quit their jobs entirely. Over 85% of trading activity was driven by retail investors. One survey found that nearly 2/3 of new investors had never finished high school. Stocks were trading at price-to-earnings ratios of 70-1. The global average was 19-1. This was not analysis. This was momentum and rumors. But the government kept encouraging investment because the stock market served a purpose. China's economy was slowing. GDP growth was falling from the double-digit rates of the previous decade. The manufacturing sector was struggling with overcapacity. Factories were producing more than domestic and foreign markets could absorb. Banks were holding massive amounts of bad debt from infrastructure projects that would never generate returns. Local governments had borrowed trillions for construction that sat empty. The stock market rally provided a distraction. It made people feel wealthy. The wealth effect kept consumer spending up. It generated tax revenue for the government. It allowed companies to raise capital through initial public offerings. Between May 2014 and May 2015, over 40 million new stock trading accounts were opened, more than 30 million in just the first 5 months of 2015. But on June 12, 2015, the bubble peaked, and then it burst. Over the next 6 weeks, the Shanghai Composite lost 43% of its value. The Shenzhen Stock Exchange, focused on technology companies, fell even more. By August 24, the Shanghai Index hit 2,964 points. Investors had lost 5 trillion euros, more than China's entire market capitalization in 2012. The government panicked. Trading was halted for over 1,400 companies. Large shareholders were banned from selling. The central bank injected 170 billion yuan. Nothing worked. On August 24, Black Monday, the Shanghai Index lost 8.5%. Global markets followed. And here's what made this different. The crash triggered capital flight. Chinese households saw the government fail to stop the collapse and made a rational decision. Get money out before it gets worse. In the second half of 2015, capital left China at an annualized rate of $1 trillion. Wealthy Chinese were converting yuan into dollars, buying property abroad, sending children overseas with tuition paid in foreign currency. Using fake trade invoices and underground banking, this created a problem that the stock market crash alone could not. It put direct pressure on the yuan. When capital flees a country, demand for that country's currency falls. The exchange rate weakens. If the central bank does nothing, the currency collapses. And currency collapse means inflation. Imported goods become unaffordable. Foreign debt becomes unpayable. Economic chaos follows. China had spent a decade building credibility for the yuan. The currency had strengthened steadily since 2005. Beijing wanted the yuan in the IMF special drawing rights basket. A collapse would destroy that credibility. So the People's Bank of China had to defend the currency. But there is only one way to defend when capital is fleeing. Sell foreign exchange reserves. Buy yuan. In the 4 quarters before August 2015, China spent $300 billion of reserves defending the yuan. The outflows were accelerating. The stock market crash made it worse, and the selling pressure kept increasing. By early August, the central bank faced a choice: continue spending reserves at this rate and deplete the stockpile, or devalue the currency and reset expectations. On August 11, 2015, the People's Bank of China made a decision. They announced a new policy for setting the yuan's daily reference rate. Going forward, the rate would be based more on market forces instead of being arbitrarily set by the central bank. This sounded like liberalization, financial reform, moving toward a market-determined exchange rate. In reality, it was a devaluation. The yuan immediately fell 1.9% against the dollar, the largest single-day move in 20 years. The next day, August 12th, it fell another 0.1%. On August 13th, another 0.6%. By August 14th, it had fallen 3% total over 4 days. This was shocking for multiple reasons. First, China had not devalued the yuan significantly in decades. The currency had been stable or strengthening since 2005. Second, the move was unexpected. No warning, no international coordination. Markets were blindsided. Third, the timing was terrible. Global markets were already in turmoil from the Chinese stock crash. This added fuel to the fire. Chinese households interpreted the message correctly. If the government is devaluing, more depreciation is coming. The central bank has lost control. Capital controls are failing. Get out now. Capital flight accelerated. In August alone, $106 billion in reserves were spent defending the currency, and the mechanism they used to raise those dollars was unprecedented. China began selling U.S. Treasury bonds. Not gradually, not quietly, aggressively, through custodians in Belgium and Switzerland to hide the scale from the market. They were not selling because they lost confidence in American debt. They were selling because they needed dollars immediately to defend the yuan, and selling treasuries was the fastest way to get dollars. Here is how the mechanism works. China sells treasuries to primary dealers for dollars, then sells those dollars in foreign exchange markets for yuan. This increases dollar supply, which lowers the dollar's value relative to the yuan, which supports the yuan's exchange rate. But selling treasuries pushes prices down and yields up. Higher yields mean higher borrowing costs throughout the U.S. economy. In August 2015, something unusual happened in the treasury market. Despite extreme stock market volatility, treasury yields rose. This was bizarre. Normally, when stocks crash, investors flee to the safety of treasuries. They buy treasuries, which pushes prices up and yields down. This is called flight to quality. It happens in every crisis, except this one. In August 2015, yields moved the wrong direction. The 10-year treasury yield rose even as global stock markets crashed. Part of this was expectations that the Federal Reserve might raise interest rates in September. But market participants knew there was another factor. China was selling, and they were selling size. Bloomberg reported on August 27 that China had cut its treasury holdings to raise dollars for yuan support. The report cited people familiar with the matter confirming the sales. Channels included direct sales from China and sales through agents in Belgium and Switzerland. China had communicated with U.S. authorities about the sales. The scale was not disclosed, but the market knew it was large. And here is the problem. China was not just any seller. China was the largest foreign holder of U.S. treasuries, over $1.3 trillion at peak in November 2013. If they kept selling, they could destabilize the treasury market. They could push mortgage rates higher across America. They could force the Federal Reserve to intervene and buy treasuries to offset the selling. This was not a theoretical weapon. This was China actively selling treasuries at scale during a global crisis, and the market was watching. Every basis point move in treasury yields was analyzed. Every data release on foreign holdings was scrutinized. Traders were trying to estimate how much China needed to sell and how long they could sustain the selling. But the selling did not stop in August. It continued through 2016. By the end of 2016, China's foreign exchange reserves had fallen from $4 trillion to $3 trillion. $1 trillion spent in 18 months defending the yuan. Not all of that was treasuries. China also sold other dollar-denominated assets, agency debt from Fannie Mae and Freddie Mac, corporate bonds, equities, anything liquid that could be converted to cash. But treasuries were the largest component, and the sales were visible in the data. Official treasury holdings showed China's position falling. But the real scale was hidden through offshore custodians. Belgium's holdings had surged mysteriously in 2011 and 2013. These were Chinese holdings managed through Euroclear. Brad Setzer at the Council on Foreign Relations documented this. China's actual treasury holdings were closer to $1.8 trillion at peak, and the selling was much larger than official U.S. data showed. Some estimates suggest China sold over $500 billion in treasury and agency securities between mid-2015 and end of 2016. This was not normal portfolio rebalancing. This was crisis liquidation. Here is what this revealed. China's reserve position was not as strong as it appeared. The yuan was not as stable as Beijing claimed, and capital controls were failing. The 2015 devaluation exposed a fundamental vulnerability in China's financial system. China's entire economic model was built on capital controls. Citizens could not freely move money abroad. These controls allowed China to accumulate reserves as trade surpluses flowed in. It worked as long as capital wanted to stay, but in 2015, capital wanted out. And when capital wants out badly enough, no control can stop it. Fake trade invoices, underground banking, carrying cash across borders, Bitcoin transfers, Macau casinos. The government tried to tighten controls. They limited foreign currency purchases, investigated large transactions, prosecuted capital flight as economic crime, but the pressure was too great. By early 2016, the situation stabilized, not because confidence returned, because China imposed stricter controls and the Federal Reserve delayed rate hikes. But the damage was done. China had spent $1 trillion in reserves. They had revealed that capital controls could fail under pressure. They had shown that the yuan was not as stable as claimed, and they had weaponized Treasury holdings during a crisis. Markets learned multiple lessons from 2015. First, foreign exchange reserves are not unlimited. Even China, with the world's largest reserves, could burn through $1 trillion in 18 months. Second, central banks will defend their currency at any cost. They will sell treasuries. They will accept higher US borrowing costs. They will risk destabilizing global markets, because currency collapse is worse. Third, US treasuries are ammunition, not just assets. They are not held because foreign countries love American debt. They are held because they are liquid dollar instruments that can be sold in a crisis. When you need dollars immediately, you sell treasuries. Fourth, capital controls fail under extreme pressure. No system of rules can completely stop money from leaving when people panic. The 2015 episode also revealed the mechanism for future crises. China's economy is slowing again. Property sector is collapsing. Evergrande defaulted. Country Garden is in trouble. Dozens of developers cannot finish construction on pre-sold apartments. Local government debt is over $9 trillion and growing. Banks are holding trillions in bad loans that will never be repaid. Youth unemployment is over 20%. Foreign investment is leaving. Factories are moving to Vietnam, India, Mexico. If capital flight resumes at 2015 levels, the playbook is established. Sell reserves, defend the currency. Let treasuries flood the market. Let global bond yields rise. Let the US economy absorb the shock. And here is the current reality that makes this concerning. China's treasury holdings have continued falling since 2015, from $1.3 trillion at peak in November 2013 to $688 billion in October 2025. That is a decline of over $600 billion. Nearly half of China's peak holdings are gone. Some of this is natural maturation of bonds. Some is deliberate diversification, but much of it is strategic selling. China has learned from 2015. Holding massive dollar reserves makes you vulnerable to US financial dominance. If you want true independence, you need alternatives. So China has built alternatives. The cross-border interbank payment system launched in October 2015. CIPS allows yuan trade settlement without dollar clearing. China has signed bilateral currency swap agreements with dozens of countries. And critically, China has bought massive amounts of gold because gold cannot be sanctioned. It is the ultimate reserve asset. But despite these efforts, China still holds over $688 billion in treasuries. And if another crisis hits, they will sell again. The question is not if. The question is when. Because the structural problems that caused 2015 have not been fixed. China's economy is still slowing. Property sector is worse than 2015. Debt levels are much higher. Capital still wants out. Wealthy Chinese are still trying to move money abroad. The controls are stricter, but pressure remains. The difference is that China now has less ammunition. In 2015, they had $4 trillion in reserves. Today, they have $3.2 trillion and they have far fewer treasuries to sell. In 2015, they could sell hundreds of billions without exhausting their dollar holdings. Today, at $688 billion, their treasury ammunition is limited, which means the next crisis could be worse because China cannot defend the yuan as long as they cannot burn through reserves indefinitely. And if the yuan weakens rapidly, the consequences are global. China is the world's second largest economy, the largest trading nation, the workshop of the world. A yuan crash would trigger competitive devaluations across Asia. South Korea would weaken the won to protect export competitiveness. Japan might intervene to weaken the yen. Thailand, Malaysia, Vietnam would follow. Every country that competes with China would be forced to devalue. This is the currency war that policymakers feared in 2015. It did not fully materialize then because China stabilized, but the threat remains. And US treasuries are at the center of it, because every country defending their currency needs dollars. And the fastest way to get large amounts of dollars is to sell treasuries. The 2015 devaluation proved that reserve currencies are not safe. They are hostages to the countries that hold them. China did not attack us debt out of malice. They did not sell to punish America. They sold because they needed cash urgently to defend their currency. But the effect was the same. Yields rose, markets destabilized, confidence shook. And the precedent is set. When the next crisis comes, China will sell again. Other countries will follow. And the treasury market will absorb selling pressure that it was not designed to handle. The Federal Reserve might intervene. They might buy treasuries to offset foreign selling, but that is quantitative easing under a different name. It is monetizing government debt because foreign buyers are selling and domestic buyers cannot absorb the volume. This is the vulnerability that 2015 exposed. The dollar is the global reserve currency US. Treasuries are considered the safest asset. Until they are not. Until the country that holds the most treasuries needs to sell urgently. Until defending their currency matters more than preserving the value of American debt. And that moment came on August 11, 2015, when China devalued the yuan and started dumping reserves. The stock market crash that preceded it grabbed headlines. The 43% drop in 6 weeks, the 5 trillion euros lost, the government intervention that failed, the capital flight that followed made devaluation inevitable. $1 trillion trying to leave. Wealthy Chinese converting savings to hard currency. Underground banking networks moving billions. But the Treasury selling made it global. Because when the largest foreign creditor to the US government starts selling debt during a crisis, no market is isolated. The $1 trillion China burned through in 2015 and 2016 was not just defending the yuan. It was demonstrating that reserve currencies can be weaponized, not through deliberate attack, but through necessity. When you need dollars more than you need treasuries, you sell. When enough holders need dollars at once, the market breaks. August 11, 2015 was not the first time a country defended its currency, but it was the first time the world's largest foreign creditor did it at this scale in the modern era. And the mechanism they revealed became the blueprint for every future crisis. Sell treasuries, get dollars, defend the currency, let global markets absorb the shock. The devaluation that shocked markets was not just about the yuan falling 3%. It was about proving that foreign exchange reserves are ammunition. And when you run out of ammunition, the currency collapses. China has not run out yet, but they are closer than they were in 2015. They have fewer treasuries, less reserve cushion, more structural problems, and the next time they need to defend the yuan, the world will watch treasury yields closely to see how much ammunition they have left. The August 11, 2015 devaluation did not end global financial stability, but it revealed that stability was always temporary, that reserves were always limited, and that the largest holder of treasuries would sell them without hesitation when their currency was at risk. That is the lesson markets learned in August 2015, and why no reserve is truly safe.